Hi, this is John Camarianos with Capital Considered. Thank you for joining us today. I wanted to devote a short segment to something called the Mar-a-Lago Accord. What is that? Well, it encapsulates a large part of Donald Trump's global economic and foreign policies. A lot of it stems from a paper written by the chief of the Council of Economic Advisors, Stephen Mirren. Mirren wrote this paper when he was working on Wall Street before the election or maybe just after the election in November, and before Trump considered him for the position he's in now. And the paper outlines a plan that has roughly three contours. Again, I won't claim I can be comprehensive about it, but here's the three main contours the way I understand them. First of all, the Mar-a-Lago Accord involves a currency change. The U.S., Donald Trump wants to reduce the value of the U.S. dollar. He doesn't say that out loud. People don't understand why a president or a political figure might want to do that, but that is what he wants to do, lower the value of the dollar relative to other currencies. And the reason for that is because it helps a country be more of an exporter when it has a weaker currency and it is exporting things to countries with stronger currencies. The background here is that the U.S. is the world's reserve currency. What that means in part is that many commodities like a barrel of oil, for example, get priced in dollars, and that means countries have to accumulate dollars, and that means the dollar has a kind of artificial boost to it for that reason. So the trick is, but that also confers a lot of benefits to us being the world's reserve currency, to the United States. And so the trick is, can you lower the currency at least a bit without making the dollar not the world's reserve currency anymore? And that's the kind of needle that the Trump administration wants to thread. Now, to be fair, we've had events like this before. After Bretton Woods, after World War II, when the dollar was set to the price of gold or an amount of gold, and the other world's currencies or the Western world's currencies were fixed to the dollar, we had something called the Plaza Accord in 1985, which literally was a meeting that took place at the Plaza Hotel in New York among the United States, Great Britain, France, Germany, and Japan. And again, at that accord, the objective of the United States was to devalue the dollar to make us a little bit more of an exporter, and that worked for a time. So this has happened before. There's no meeting that's going to take place this time at a resort like Bretton Woods, which is a nice resort in New Hampshire, and you can still go to, or at the Plaza Hotel. Nothing's going to happen at Mar-a-Lago. There's no meeting that's taking place, but it's still a good way to describe what Trump's policy is here. So that's one thing, devalue the dollar. The second thing is the United States famously now has 35 or 36 trillion dollars of outstanding U.S. treasuries of debt. And that's a lot. That exceeds our annual GDP. And the interest payment, importantly, as some people have explained to me, exceeds the amount that we spend on defense. And Neil Ferguson, a historian at Harvard, wrote an article, an op-ed recently, arguing that when a world power, when the amount they spend on servicing their debt or interest payments exceeds their defense spending, that world power goes into a decline, and sometimes a rapid decline. And so there's a very large incentive to reverse that here. And so part of the Mar-a-Lago Accord, the second part of the Mar-a-Lago Accord, is a debt restructuring. I think this is going to be harder to achieve. So countries that export to us take the dollars they receive and buy a lot of U.S. treasuries. And the Trump administration would like them to convert those treasuries into something like 100-year zero coupon bond. So this debt instrument that you hold that never pays you an interest rate and that you finally exchange or get paid on in 100 years. That's a kind of weird default, to be honest. And it's unclear that other countries will accept that. Will convert bonds that they're getting paid steady interest on now for this other kind of 100-year instrument for which they get paid no interest, except they get their money back at the end after a century. That's less likely, in my opinion, and it probably does constitute a default, and it might technically be unconstitutional if it's deemed a default, because I believe constitutional scholars may may argue about this, but I think it's unconstitutional for us to default on our debt. So that's the second part of the Mar-a-Lago Accord. The third part of it is the Trump administration is trying to connect a kind of debt restructuring to whether a country falls under our military protection. So if you're nice enough to restructure your debt with us, we'll deliver the military protection that we've previously delivered for free in some sense. And if you don't, we won't. It's also less clear if countries will accept that. And of course, we see that Europe now is scrambling to improve its own defense forces, especially given the situation in Ukraine. And the Trump administration's unwillingness to defend Ukraine the way the Biden administration did. So those are the three contours of the Mar-a-Lago Accord as I understand them. It probably means a lot of volatility is ahead for financial markets, and it means maybe one other important thing for financial markets. Donald Trump in his first administration took the stock market to be a judge of his performance. If the stock market was performing well, he took that to mean that he was performing well. I think the stock market still matters to Donald Trump, but I think it is now in second place on his list. The most important thing, what's in first place on Donald Trump's list, is the bond market and the yield on the 10-year Treasury. What does that mean? The 10-year Treasury bond is a loan to the U.S. government. If you as an investor own a 10-year Treasury bond, you have loaned your money to the U.S. government for 10 years. And the yield on that instrument is something like 4.2% right now, which means that's what you're getting paid as the lender, and that's what the U.S. government is paying you as the borrower of your money. And of course, it's in the government's interest to have that payment, that interest payment, be as low as possible. That's also what's behind DOGE, the Department of Government Efficiency. We want to show the bond market that we're cutting our expenses, that we're sort of getting our financial house in order. And that's why, and also it's important for Donald Trump to accomplish his tax cut. In the UK a couple of years ago, you may recall Liz Truss was the prime minister for, as Anthony Scaramucci likes to put it, 4.1 Scaramuccis. So Scaramucci was, of course, had a high press position in the Trump administration, the first one for 11 days. And so she lasted, four times that amount. So a very short-lived tenure as prime minister, because she proposed a big tax cut she thought the country would be able to finance with higher growth, but the bond market basically rejected it. Investors crashed the bond market basically and rejected that tax policy. And Donald Trump knows it can hinder his administration considerably if he proposes a tax cut and the bond market effectively rejects it. So these are all the things that are going on at a higher level and are probably responsible in some ways for all the volatility in the markets today. Hopefully it gives some of you a better idea of what is going on at higher levels of government regarding the debt we have, regarding what we want to do with our currency, and regarding the primacy of the bond market right now. So hope that helps. This is John Kumarianos signing off for Capital Considered. Thank you for watching.